All right, guys. So we're going to go ahead and get started. Thank you all so much for being here. Couple of quick things right off the top. If you look up here, you'll see that there are 3 things that we're going to talk about a little bit tonight. But to make it easy for a little bit of a participation section we got a little bit later, you'll see got 3 places to go. If you check in, everybody who filled out a poll, if you want to kind of get a pulse of everybody else in the room, you can go in, see what the poll results are, and that'll kind of give you an idea of what people think to the same questions you answered. If you've signed in, you'll also be able to be part of the matchmaking services that we're trying to encourage people to check in. And you can just click there. It says AVL Meetup Matchmaker. And then last but not least, we've got the have, wants, and needs board that we'll continue to talk about. It'll be a good place to keep networking and getting some transactions going. So tonight, right off the top, just want to say thank you to our sponsors for tonight, which is Zen Contracting, CFO Consultants, and Sabrina West Mortgage Lending. Thank you guys so much for your support. So after that, we're going to talk about Let's Make a Deal. It's just going to be a quick overview of the net profits philosophy and how we're trying to embody that. Then a quick Ruiz Report market update, followed by some table discussions, and then what everybody's here to listen to, which is our panel on what's going on in our economy and what's coming next. All right, so our goal for AVL Meetup is to bring together the movers and shakers in the Asheville real estate world. So that's all of you all. Thank you so much for coming out. Thank you for being movers and shakers. As you'll see, one of the best parts of the community is everybody else in the room. So bring a friend, make sure they're a mover and shaker. And if everybody brings a mover and shaker with them, then there's more opportunities for good conversations, more opportunities to put some deals together, and more opportunities to connect with other people. My name is Rodrigo, co-host this with Zach, but I run a company called Vesta Property Management. So if you need any property management for any long-term rentals, would love to connect with you.
My name's Zac Ruiz. I run the Ruiz Report, which we're going to go over here a little bit later, and I do a lot of real estate data and analytics. I'm also the developer of the website, so as we're doing all these little features, would love any feedback. If it works, if it doesn't work, let me know, and we'll see what we can do about that.
Zach loves the extra work. So we're about the net profit philosophy. If you've been here before, you've heard this, but it's very important, so we're always going to touch on it. Net profit philosophy stands for networking, education, and transactions. We believe that all of that put together is very important because net profits is what matters. It's not the gross transactions. As you can see, nobody cares about the gross, right? So networking. Couple questions. How many realtors in the room? Just raise your hand. Wow, that might be the smallest number ever. Investors, primary focus is investing.
Nice.
And lenders. All right. Is there anybody who's all 3? Couple of all 3. All right. And then service provider. So maybe you're not an investor or a lender, but you're, supporting
a tradesman, anything.
Tradesman?
Yeah, why not? Yeah.
So a couple of people. And Zen, of course, in the back. Thank you. And Ben as well. Are there 2 of these?
Well, then we have NREPs, right? Non-real estate professionals. Are there any normies in the room? Does anyone just come to learn about the economy by any chance? Oh, we got one. There you go.
A couple of people. Thank you for being here.
Welcome.
Bring your friends.
Bring your friends.
So feel free to connect with us online at AVL Meetup. We're really trying to focus on YouTube over the next year. So help us reach our goal of 1,000 subscribers. And that way we'll keep doing the videos and you can always watch these and not just listen to these as well. So help us get to 1,000. Oh, if you want to help us volunteer, please see Ray in the back. Ray, say hi.
Looking very festive for the holiday season.
Yeah. And then also, if you have any feedback, please connect with Scott or email Scott.
Scott McGee is the man to see. There he is.
Make the back end a little bit smoother. So any feedback is always appreciated. Education.
All right. So the second part of the net profit philosophy is education. And that's what we're doing right now. Right. So it turns out this is the 23rd AVL Meetup. We have covered a lot of topics. So if it has anything to do with real estate in any way, shape, or form, we've probably talked about it, and we hope to continue talking about it in the future. As you can see at the bottom right there, we're at the state of our economy and kind of a precursor of what's happening. This same meeting last year had around 100 to 110 people crammed into a room because things were hot. And there are a little fewer people here, right? So moving on, as you can see, we've done, of the people who checked in, and if you look around you, right now we have about 37 people who've checked in. You'll notice there are more than 37 people in the room. But based on the people who've checked in, we've at least done 2,950 network and education hours. We've had at least 1,044 people check in, and we've had 62 speakers. That one's for sure. So here's our Hall of Fame. Everybody on this wall is at the top of their game in some way, shape, or form, as some of them are in the house again tonight. So pay attention who you're talking to. You can see them in their member profiles. And finally, we have transactions.
So transactions is personally my favorite part. I always say is we talked about is like networking and education. If you do those two things well, transactions are just the natural result of those two activities done well. So we've spent 2 years trying to figure out how at AVL Meetup we can do something to encourage transactions other than just say, hey, we believe in transactions, talk to people, do deals. So what's the hardest part of doing deals in a room of people that you might not know everybody is? Like, who do you talk to? Why would you talk to that person? So we're introducing the matchmaking service. If you checked in and you click on your bobblehead at the top right, you'll have the opportunity to look at this menu. So if you're looking to buy something, you're going to be connected with people who have said that they're looking to sell something. If you're looking to lend money, you're going to see who are the people who are looking to borrow money. Vice versa. If you're looking to raise money, then you're going to be able to connect with people who are raising their hand and says, I'm actively trying to lend money. And so the goal of this, right, is that you can walk away some networking and education that leads to some really good transactions, some like very good structured, a little bit sniper focused action. There is one catch though. It's only going to be available during the meetups. So the matchmaking service ends tonight, and then it'll come back again next month during the meetup hours. And we talked a lot about like, what are we going to do in between? And so then that's where we got the have, wants, and needs board. So there's a quick, is like 10 seconds video, right? So this is how you post something on the have, needs, or have, wants, needs board.
Very simple. Hit the plus, type what you need at lightning speed. Say if it's a have, a want, or a need, and you're done. That's simple, right? And you can comment on it, reply to other people, and all that great stuff. And that's what it ends up looking like, right? So this is essentially an ad for you. So format it, put in links, put in a list, like make it bold and italic, all the usual stuff, right? Attract people to what you have, want, or need. And then all you have to do is log on and you can scroll through and see everyone's have, wants, or needs and comment right then and there.
And you can also sort it by have, wants, or needs. So the one tweak on this is the needs disappear in 7 days, right? 7 days?
Eventually.
Yeah. So if it is a need, we're going to treat it as such. If it's a want, it'll stay around a little bit longer. All right. So please fill out your profiles, because if you post something on the messaging board, people might want to get a hold of you. And the best way to do that is if your profile's filled out so that I have a little bit of context on who you are. And as we always say, you're just one conversation away from the next deal, your next partnership, the next money that you're going to be able to raise. So have the conversations. And on that note, we're going to do 8 minutes to do structured networking around the matchmaking service. So if you signed in, go ahead and take this time and talk to somebody who's got something that you're looking for. And vice versa.
See you in 8 minutes. Meet the people at your table.
Hi, I'm Sabrina West, your local mortgage expert with Guaranteed Rate. We provide you and your clients real talk in real time. I am a mentor, investor, and money mortgage expert that provides you with customized consultations with a behavioral finance approach that helps you build wealth through real estate. We believe in clients for life, so reach out today for your customized consultation.
All right, so we're going to kick into the report segment of the meetup so we can get to the panel. It's going to be a little bit different than we usually do. We're going to quickly cover the report, kind of change it once we get to supply and demand, and that's where the rest of the night's going to head. So my name is Zac Ruiz. I run the Ruiz Report, and we are on the 45th edition. So it started the month of the pandemic, and we've seen some fun changes. It has been a time, right? So the Ruiz Report, our mission is twofold. One, we want to equip realtors and basically, investors, anyone in the market, with data-driven market insights with a 10-slide presentation, and we're going to go over 3 of them tonight. And second is to empower them with industry-leading training to become that local economist of choice, and tonight is part of that. We're going to train you a little bit about the data, right? We're going to start with the graphs, because why else do you show up to a brewery at 7, right? So pretty shapes and colors is how I like to call them. Don't worry about it, all right? If you don't like math, you're good. We're going to tell you how to read the graph, and this is how it goes. On the far right, you're going to see the report month, and you're going to know it has a little green box at the bottom. For our purposes tonight, we're going to be going over November. On the left, with the red box, you'll see the year over year. So that's 12 months. And then you'll notice that there's 2 months leading into it. So that's a little seasonality. All right, that's 3 months of the year. It's last quarter, essentially. What did that look like? So we can kind of get some trends. And every graph follows this pattern. So congratulations, you know how to read a graph. So first, we're going to go over volume and activity in Buncombe County. And the point, what we're looking for here is the height of the bar. The red bar is the total active listings, and that's how many homes were for sale, residential homes, at any given point during the month. That is all of the available inventory. And then the green is those homes that sold, which remember were probably under contract from a previous month. And then the homes that went under contract in that month. So basically the green bar is the inventory coming off the market, whether forever or temporarily while it's under contract. And you can see that compared to last year, where there was a dip coming into November, well, we're experiencing some version of that dip again. So seasonally adjusted, it makes sense that less is happening. Listings and pendings, this is my favorite slide. We're going to talk about this a bit tonight. And you'll see here there's a pro tip. So keeping an eye on the difference between homes added to the market, that's the red bar. Those are new listings in the month. And the green line, so homes taken off by going under contract, that's the green line, is the best way to gauge supply and demand, right? This slide tells the story of supply and demand. And this is how you interpret the graph. When the red bar is above the green line, as you see here highlighted in yellow, then that means we added more inventory to the market. We put more new listings than we took off. And analogously, when it is below that gap that's highlighted in yellow, the gap is how many homes were removed. That's supply being reduced overall, right? So as you notice here, since about March, we have been adding more inventory to the market than we've been taking off. This is somewhat new. This has not been happening since about 2020 or so, right? So we've been consistently adding supply lately, but it's not enough. And that's what we're going to talk about. How do I know it's not enough? Well, supply and demand directly affects pricing. Just think of any other area in your life. Same thing happens in real estate, right? So let's look at prices. The average price of a home in Buncombe County for November, based on all sales, was $701,000, right? So you'll notice at the bottom there's a little explanation of why the red line is above the green line. The red line is the average. So that's if I took everything that closed in November and then divided it by how many there were, that's my average. But the median is if I took them all and went from the least expensive home to the most expensive home and I picked the middle. And what this tells us is that in November, the median, 50% of homes in Buncombe County were at least $485,000. This is an expensive county. All right? This is a thing, right? So the pro tip here is one of the things people talk about all the time is that prices are coming down. Prices are coming down. Well, you're noticing that people are having to reduce their list price. But the list price is just an advertisement. No one agreed to that price. The price that matters is the close price. And you can see the trend line of the close price in Buncombe County is still up and to the right. Now, it may not be as hockey stick shaped or as aggressive as previous months and periods, but it is still up and to the right. Prices are still, for some reason, increasing. And that has to be because supply and demand, because interest rates are significantly higher. So the home is more expensive, and that you would think that that would make them less expensive. Which brings us to Zac's Economics 101, part 2. All right? We gave this class last year, and we're going to go over it a little bit with some clarifications and some updates. So basically, all we're going to talk about tonight is how are interest rates calculated, and you might think it's like this, right? You may, we're going to raise it today. Like, why not, right? Turns out there's a little bit more to it. And so an interest rate is essentially comprised of more or less 4 parts, right? The first part is the federal funds rate. When they say that the Fed is going to increase or decrease, that's what they're talking about. And here's the graph. So if you look on the right, that little red block, well, it went from nothing, 0, right, to something, about 5% and change right now. We're going to talk about that, right? The next thing is the prime rate. The prime rate is basically if I was the most creditworthy person that's not the US government, what would you charge me? And that's about 3%, right? But you can see that it's going up, and we'll explain that shortly. The next thing is risk in general, right? And all you got to do is turn on your favorite social media platform or news, and you will know that the world's a little risky right now. Whether it's geopolitical, interest rate, pick your risk, we got it in droves. And then the last part is you, right? When they're analyzing your profile, how risky is this person, right? So let's take a look at these individually. So like I said, the federal funds rate from our last meeting says about 5.25, 5.25 to 5.5%. That's where they're looking to keep it. The prime rate is basically fixed at 3, and that's not it, but this is it. And so what does that mean, right? The prime rate is said to be pegged to the federal funds rate. So if you look at the shape of these graphs, they look the same with one difference. When the bottom one is at 0, the top one, which is the prime rate, it's not, right? So it's adding that, it's pegging it to it, and that difference is the federal funds rate, essentially, right? So risk in general, well, that's increasing. We know whether it's wars or everything that's going on, there's a lot of risk. And then there's you. Hold my beer. All right, so we're going to go over the same slides, but year over year change. So you, credit card debt. You'll notice the red line is the same slide from the same source. This is Federal Reserve, funny enough, from Lending Tree. But the red line was last year, and then the yellow line is where we're intersecting this year. So on the left, we have outstanding credit card balances, and there's about a 22% increase year over year. On the right, we have percentage of total outstanding credit card balances that are at least 30 days overdue, so delinquent credit, right? About a 72% increase, right? You're a little riskier. We're going to talk about this. Chris is going to talk about this. Well, basically, banks are preparing to have to write off loans to some extent. They're preparing that maybe they won't be getting paid back timely. Student loan and auto debt, like a big chunk of people's debt, well, kind of the highest it's ever been. Right? Even though it's tapering off in the last little period there, we have until January of 2023, it looks like. It is a lot, right? Mortgage debt. This is from the Federal Reserve again. Mortgage debt, you'll notice it doesn't go to 2023. This is a little bit lagging metric. We're still up and to the right, right? And now for the real kick in the, we've got median income. Let's look at real median household income in the United States from about before the pandemic to now. It's not looking good, guys. So we need to spend more money on debt, and we're making less of it. Hey. By the way, there are nothing bundt cakes in the back where the noise just came from. If you haven't grabbed one, go for it. Right, so combining these factors together causes mortgage rates to kind of look like this at the bottom right, right? So mortgage rates have been going up. They have to, right? Your riskier risk profiles are going up. The Fed is raising its rates. All the combinations of what an interest rate are increasing. And if you just draw like a line, right, the last time we hit that same amount was about February of 2000. So these are the highest rates we've seen in about 23 years, right? So let's do some quick math. I wanted to use this meme. I didn't know where to put it, but here's where we are, right? So we're going to do some quick math, all right? So this is all of the outstanding mortgage. And you'll see at the top, I've got a green box. It's between 3 to 4%. The biggest chunk of outstanding mortgage right now is between 3 to 4%, right? So let's call it 3.5. Then we've got the average outstanding. Remember, we're just doing average nationally here. And that's 241,815 of mortgage debt. We're going to call it 240. And even though that's the weirdest rounding you've ever seen, it's because I made a typo and I didn't want to go back and do this. So if you go to the mortgage calculator for North Carolina at our 3.5%, which is what we said most of the outstanding debt is, for 240,000, which is what we said most of the outstanding debt is, your monthly payment is $1,492, right? Problem is, today, at the average of 7.5, that would be the equivalent of a $174,000 home to get that same monthly payment, right? So seller's next home needs to be 28% cheaper to have the same payment. Or sellers need to apply a 28% net profit, a fun term we like, towards their new home to get the same payment, right? Well, let's look at some other areas needing cash. So the average student loan balance in the US right now is around $38,000. Average credit card is about $6,400. Average auto loan is about $23,000. Most people, some of the HELOCs that exist, were at about $42,000. There's a lot of money that needs to go out to become whole, right? So found another fun meme. You know, you can't really run away from your problems forever, but he's really fast, right? So it looks like many sellers will be forced to trade horizontally or down. That is not the greatest incentive to sell. Another slide we got from DLP Capital that we'll be speaking to tonight as well is that housing affordability is the worst it has been since 1984, right? Renting is looking like a potential option in some of these cases, right? So let's just recap really quickly. House prices are at historic highs, all right? Interest rates are at their highest years in 20 years. So what does that mean? The house has two prices, one of the things I say, right? So unless you're buying with cash, it's the sticker price, and then there's your monthly payment, which is based on your debt to income ratio. If real income's going down and debt is going up, the house is getting twice expensive in two separate ways. right? You really can't, you could afford $1 trillion house if it was a 0.00000% interest rate. The sticker price isn't as important to most people financing. It's about their debt to income ratio. And that's where the interest rate comes in. So all signs points to price reductions, except, well, prices. Prices have continued to be, sticky or at least increasing a little bit. Right, so we're going to go to our first table, or first table question. We're going to give you 5 minutes, flick the lights. You're all going to come back. It's going to be very respectful and nice. And here's our first question. Are you or anyone you know in this golden handcuff situation? I am in this situation. I bought a house hack that I was like, this is going to be a great chess piece. And I'm stuck there because I have like a 3% rate and it would be very expensive to get out, right? So are you in this situation? And if you are, what's your plan? So we'll give you 5 minutes on the clock to talk about that.
What's going on, everyone? For this month's Luxury Real Estate Meetup, we have Zen Contracting, who is a sponsor for Net Profit Summit. And if you've been coming, they're the ones that gave away the huge DeWalt kit. So they're big supporters. If you haven't had an opportunity to connect with them, Zen Contracting, they pride themselves in delivering a good product for rehabbers, landlords, and for anybody who's looking to have a different level of communication and multiple touch points throughout their projects. We really encourage you guys to check them out on their website or at the link down below, and help us in saying thank you for sponsoring this month's event.
Is there any table that wants to share some feedback from the table conversation? Is this a normal occurrence, not so normal occurrence? Any volunteers give feedback to the group?
All right, Katie Rice. Can you?
Yeah,
we're gonna get you a mic. It's for the people at home. It's for the people at home.
No, go for it.
Check. So what we were talking about was what's happening is, I said, if you've lived long enough, I hate to date myself, but interest rates at 8% really aren't that bad, right? Anything over 10, anything under 10, I think is awesome, especially if you've done private money lending and things like that. Mm-hmm. But we're comparing it to where we're coming from, to your point. So if we're at 5, 3, 4, 5, right, and now we're trying to move up into 8, that's the difference. So we have to have this like larger picture of like 8% isn't that bad. Let's take it into, context. We're not in the 80s. We're not at 15%, 16%, which could happen. Be grateful. But we're still having to deal with the shift and the change, which is, how do we sell a place? We're going to have this 30% difference in what we can expect.
Yeah. Definitely different now. Anybody else? Feedback? Anybody want to share? Come on, one more person. All right, thank you. The mic doesn't reach that far, so you'll have to yell. The recap. I was not planning to recap.
All right, so
okay,
the recap is,
Zach's going to deliver.
It may be that the math of you moving doesn't make as much sense. So what you do is you rent the home that you're living in now. You use that rental income to offset the income needed for your debt to income on the next place. You put down 5% to get in the next place. Your rent pays that mortgage, hopefully a little bit more. And you make moves. You get in the game, which kind of brings us to another question here.
We had a lot of conversations about what would be a good question. Whether you should sell or not was definitely a question we played around with. But I'm assuming everybody knows Grant Cardone in this room. I don't know if anybody saw. He had a little video that I was very interested in. And he said that we will be seeing 50, 60, or even potential 100-year length mortgages in our lifetime, depending how old we are, I guess. And that's the question. As a lender, do you think that's going to happen or not? I've seen some 40-year mortgages that have come out that have been structured to make things affordable and to make people, as he says, feel like they own something that they don't really own. And the logic made sense, at least from where I was sitting. But again, I don't write any loans, so I can't comment on it. So 5 minutes, is this going to happen? And how many years are we going to see? We're already seeing 40. Is it going to keep going up, or is it going to come back down?
My name is Ben Wan, and I'm the owner of CFO Consultants in Asheville, North Carolina. We are an accounting and consulting firm that provides end-to-end support for small business owners. Too often, accounting firms provide business owners too little, too late. We believe in doing the complete opposite. With CFO Consultants, you can truly feel that you have someone by your side who helps you understand the numbers to help you run your business and achieve all of your goals.
All right. So if we can start, Wes, we'll start with you. Maybe just do a quick minute introduction onto who you are, what you do, and then we'll just kind of do a minute introduction each. We'll just go down, and then we'll roll into the questions afterwards. Go ahead and set the stage.
Okay, sounds good. Hey everybody. I am Wes Reinhardt. I am the co-founder of a primarily commercial property management company here headquartered in Asheville called Altamus Property Management. I've lived in Asheville for 20 years, originally from New York. Originally had a Wall Street career and relocated here and reinvented myself into commercial real estate. And I'm a licensed real estate broker, but I spend most of my days in property management, and we do multifamily, and we do association management as well. So I know most of the people here seem to be residentially focused, so I hope I'm not over my skis, but I'll try to share whatever enlightenments I have.
Two fingers?
Two fingers from the mic, please.
Watch the video.
You
did great. Thank you.
All right. Well, I think it's important to say I feel underdressed. You guys look very sharp. My name is Andrew Davis, and personally, I've been investing in real estate for about 13 years, single family, small multifamily, vacation rentals. And professionally, I work for DLP Capital. I've been in investor relations for close to 4 years now. I've raised about $500 million for commercial real estate acquisitions from multifamily, self-storage, hospitality, debt, and car washes. And my current role is Director of Investor Success at DLP Capital. And we are primarily focused on workforce housing in the Southeast and Texas. And so basically, we just have a self-imposed mandate that the housing that we either invest in or lend on is going to be affordable for the American workforce. So glad to be here with you tonight.
Heck yeah. Thank you.
Good evening. My name is Chris Youngblood. I'm a commercial lender with First Bank here in Asheville. We loan money for construction, commercial real estate projects, and also commercial and industrial, which would be operating companies, folks that make stuff, or service companies that provide service like HVAC services. But yeah, happy to be here. Look forward to talking with you guys.
Awesome. Thank you. All right. So actually, Chris, if we can start with you and we'll kind of come back this way. So the question is essentially, given do you agree with the picture that was painted, I suppose? But given current market conditions, how is your organization kind of preparing itself to deal with this? We alluded to how First Bank is maybe getting ready to potentially have to, write off some or get less debt payment coming in. DLP was saying that home affordability is at all-time low. So maybe we're looking at different investment vehicles. And Wes, when we spoke to Wes was like, armchair economist. So don't put me in deep waters here, but also very modest. One of the properties managed is the Grove Arcade in downtown. These are a great mind here. Would love to hear what you have to say about that as well. So again, now that I've talked too much, the question: how is your organization preparing for the economy ahead?
Sure. Well, as you guys have probably seen on the television, and if you've borrowed money, you perhaps have experienced interest rates are at a high, at least relatively speaking. The Fed funds rate went up 5 percentage points in 14 months, which is really unprecedented. It's a historical level of growth. I mean, there's been other time periods where interest rates have gone up more, but not as fast. So what this has done is a number of things. It puts stress on consumers. So if you're a commercial lender where you have loan money to businesses that are dependent on consumer spending to pay you back, you're gonna look closely at the factors that play into, can my customers pay, continue to spend money at a level that gets the bank paid back. It's a complicated undertaking, and there's no one answer or one way to do that sort of math and that sort of forecasting. But it's something that is taken into consideration as we put credit out on the street and deploy capital. I would say, another thing that is coming up is two things. One is that with interest rates being higher, the math doesn't work the same way that it did 5 years ago or 2 years ago. So more people are having to stand on the sideline, perhaps because they're not in a position to participate because the math doesn't work. Before they could afford a $450,000 house or a commercial building and now they can only afford 300 or 250,000, and there's not a lot of those properties floating around, so people are going to have to kind of wait it out. Related to that is, if the math doesn't work the same, people have to put in more of their own money, and folks are saying, hey, do I want to drop my liquidity or cash position below a level of comfort? And if I do that, what happens if there's further downturn or erosion in the economy? There's a reason that cash is at the top of every balance sheet. It's really important. It puts you in a situation where you don't need a bank if you have a good liquidity position. And the other thing, the last thing I'll mention, I've talked a lot just on this first question. The last thing that I'll mention is that loans that we did 3 or 4 years ago at 3% or 3.5% or 4%, when those loans balloon, which are commonplace in the commercial real estate market, if the new rate is 7.5% or 6.5%, or if there's high risk, it's in the 9s or 8s perhaps, the math doesn't work. So one of two things happens. The bank enters into a workout situation, which most banks do. We don't want to own real estate other than the branches we own, or we require that the borrower put in liquidity to bring the loan back into guidelines. So, the risk there is, can the loan be brought back into guidelines? And if it can't, we have to downgrade the credit rating for that borrower. We have to file, we have to file with the Fed that maybe we entered into a workout arrangement with this borrower. So it can get complicated really quick. But anyway, sorry to talk so much, but passionate about it.
We'll just skip you for the next question. It's fine. Don't worry.
Yeah.
Yeah, I think for us, we responded in a couple different ways. We have 2 equity funds and we have 2 debt funds. And so our largest fund is our housing fund, and that invests in existing multifamily assets throughout the Southeast and Texas. And for us, over the last 14 months, we've done no acquisitions. So $2 billion in assets in that fund, but we've just pressed pause because, similar to what you saw with single family prices, multifamily prices have gotten to a level that it doesn't make sense for us to invest based on our criteria. And basically what we do is, any market we go into, we take the median household income in that market, and then we basically guarantee that we are not going to raise rents in that community above 30% of the median household income. And we feel that that's a great service to our tenants, but it also keeps us really honest with our underwriting and make sure that we're really sticking as value and basis investors and not speculating on rent growth or coming into a property, renovating it to the hill, jacking rents up and selling it, because that's not a sustainable strategy. And so as we pressed pause on acquiring existing assets, what we've done is we've pivoted to development. And so we started what's called our Building Communities Fund. And what we found is, because we're vertically integrated and we have construction and development and property management, as we started to see these prices of existing assets get to a level that just made no sense from an acquisition perspective, we saw land prices become more appealing. We started to see labor costs drop. We started to see material costs come in line to where we could buy raw land, develop it, and get in at a basis of a brand new asset that was lower than existing assets in the marketplace. And so what that looks like, depending on the market, depending on the land price, et cetera, is somewhere between $175K to $275K a door. And if you paid attention to multifamily, what they've been trading at, it's 350, sometimes 400K a door. And so for us, able to add a tremendous value in the community, but then also get it at a really solid basis in that fund. And then as interest rates have gone up, debt has become harder to come by, especially for ground up development. And so we have a debt fund as well. So we've been able to provide a real valuable service to people that are operating in the same communities that we're investing in as well. And so our debt fund has grown substantially over the last 12 to 16 months. So in terms of how we're positioning to just kind of for what's ahead, we don't know. Nobody does. But just getting really conservative on our terms. So in the debt fund, we only do senior secured mortgages with personal guarantees. The average loan to value in that fund is about 55%. So we're positioned very well in the capital stack. Even if you see values significantly decrease or we see a high number of defaults, we're still positioned very, very well to preserve investor capital and make strategic moves with the debt in that fund. So that's how we've responded.
Wow.
Nailed it.
I agree with everything they just said. I have a little bit of just a different perspective because I'm coming at this question from a property management perspective, right? So like, we're an organization of 14 employees. We have construction services, we have maintenance, we have accounting, and we have a collaboration with Dewey Property Advisors, who's what we call our sister company, which handles the brokerage. And so for me, when I look at this question, it's all about ownership goals, right? Like, we're working for the landlord, the owner, and every owner's goals are different. So we try to tailor. So whatever the market is telling us about, inventory or prices or interest rates or what have you, ultimately that question can be answered differently by every owner because they're at different bases, they're at different entry levels. What I sort of preach to my team is a couple things. The first thing is this, like, what is the ownership goals and how are we going to execute on this? What people don't understand, no matter what all these, market headwinds may be or dynamics, what I preach to people is we're not putting a person on the moon here. This is property management. Like, it's simple. Execute on what you say. If you don't know your answer, tell the owner you don't know, and then go find it. And you'd be surprised at how many people in property management and any occupation for that matter don't do that. It builds incredible confidence in an owner when you can tell them that you don't know the answer, but you go get it. So it's the simple blocking and tackling that I think is important for how we look at the marketplace right now. And so the other thing I would say is that I've also told my employees to date is, headwinds will, your mistakes will be magnified because of some of these economic headwinds. So let's be careful not to make too many mistakes. And mistakes are forgivable. We all do them. We're not running a perfect shop. But when owners for the last 10 years have had an incredible run, an incredible return, and all of a sudden now they're talking to Chris and he's got to refinance them, and it's at terms that are different and the construction costs are different, et cetera, et cetera. Well, all of a sudden they're not feeling as good as they did over the last 8, 7, 10 years or whatever it might be. And so I want to reduce the mistakes because an owner will find a reason to blame somebody but themselves. And I don't want to be in the crosshairs of that. So I'm not sure that fully answered your question.
No, that's great. Just, I think moving in on kind of like the local side, as far as I've heard from a lot of different people, I'm sure everybody else in the room has, like, going back to the fundamentals and like really having really intentional focus steps is very important right now. What is the impact of that locally that you guys are seeing? Obviously you're gonna have 3 very different viewpoints or vantage points, but and maybe we can work through this question a little quicker, guys. Sorry, because we have more than like 3 questions, but what are you seeing at a local level? Like, I think a lot of people who are in business, probably a lot of people in this room, weren't around in 2008, or if they were doing something totally different. So what is going to be that ripple effect
Locally.
We're going to go back.
Yeah.
So
Sorry.
I'll be very more concise. I think, I am a bit of an armchair economist, and that's worth nothing. But I think what we have to be mindful of here locally is no different than any municipality in the country, which is, you have rising interest rates, falling property values, and all of a sudden the income, the property tax revenue is not enough to support the infrastructure. And so what you get is you get these quality of life issues that we're seeing in other cities. And what happens is that becomes a very difficult gap to fill. And the problems multiply. And so my concern here locally would be, exactly what I talked about. And we all know them. I'm not pulling any punches about what those quality of life issues are. As far as, policing and homelessness, all real issues in our marketplace. But I would be concerned that we won't have the tax resources to solve some of these social socioeconomic problems.
So to your point, actually, we'll try and get this for you guys in the show notes. But this morning, the Citizen Times did a piece on just that. There's going to be a budget shortfall, and they can't make up for it, right? So they were trying to get their levy. They're saying that they're going to try not to levy property taxes, but that is just the reality, right? It's just you got to balance the budget in some way, shape, or form.
Andrew, how about yourself? What are you seeing at the local level, ground level?
I mean, I would come at it again from the workforce perspective, and I think, you know, what you see, and it wasn't on that particular slide that I shared, but for you've got that housing affordability being at the lowest or the least since 1984, but then you also have the highest number of people in history spending over 50% of their income on rent. And so you think about, I can't tell you how many conversations I've overheard just being out and about in Asheville, people lamenting that their lease is up, that their rent's going up, that they need to find a place to live. And so I think what it really does is it just creates, it's what Wes was saying, right? It's the instability for the workforce, or the people that we interact with every single day that are doing really valuable services and work here in our community, but just aren't compensated highly as some of us. And so it creates instability in our community. And I think that's a great cause for concern, because everybody should make a living wage and have an affordable place to live where they're not spending a disproportionate amount of their income on housing. So I mean, there's plenty of impacts, but that's the one that's front of mind for me.
Cool. Thank you.
Yeah, I mean, from a perspective of activity, kind of going back to what I said earlier, not to rehash all of that. I don't want to ask you to sit through that again. Activity is slower. There's less transactions going on. If you drive around town, you're like, oh man, they're building another apartment complex. Well, all of those were planned out probably 2 or 3 years ago, but activity now, new starts have slowed down. My teammates and myself at the bank, we're not getting people coming to us saying, hey, we need to add 20,000 square feet onto our factory. So the Fed's goal of slowing things down for the most part is work. I mean, there's still inflationary pressures. Consumer spending is still going well if you're on the receiving end of that. But so activity has slowed down a bit. And from a development perspective, as we're seeing it at least, and then from a commercial and industrial standpoint, these are companies that either make something or sell something or provide a service. That has slowed down as well. And when those companies buy less, it's a trickle down effect. They have to buy those products from somewhere. And so they're buying less from other businesses. Those businesses are experiencing margin compression, reduced profits, lower revenue, and it trickles down to eventually employees and maybe the need to have less of them. So it's an interesting situation. We think that it'll turn around probably in not to get ahead of the questions, but we think it's going to turn around, start turning around next year. But things are working out as the Fed has designed. The purpose behind raising interest rates or it's the only way to combat inflation, and it slows down the economy.
Awesome. Well, that's actually a great segue, Chris. We'll start with you and come back. So the overarching question is, how would you recommend that people navigate these current environments? Like, what is the actual nuts and bolts advice that you're giving to your clients? And I guess if each one of you could kind of answer respectively. So from the bank's perspective, so I guess people looking to lend. From the fund's perspective, people looking to place their money. And then for your clients, if that payment is coming up and it's not looking the same, well, how are you recommending?
We're advising people to just be very mindful and be very deliberate of engaging in an expansion or asset acquisition or even anything that involves spending money. We're in the interest of loaning money, and we as you may imagine enjoy realizing interest income at the bank. But our first job is to protect our clients and to be good advisors. And with uncertainty in the economy comes hesitancy, and I think that's a smart way to approach this. So we're advising folks to be careful. If bringing on new business creates a concentration exposure for you, perhaps be mindful of that. What if you make an investment in your business to meet the needs of that new customer that now maybe makes up 30% of your revenue, and that revenue goes away? You know, how can you address that? So we're encouraging people to be mindful of their liquidity, put themselves in a position where you don't need a bank necessarily, and just kind of wait this out. What goes up must come down. It's very rare that the Fed has these soft landings that you may have heard about that they try to construct. Usually they either undershoot and they keep raising rates, or they overshoot and they start lowering rates. And like I alluded to earlier, we think that rate decreases are going to begin next year.
Thank you. What about you, Andrew?
I'm just going to do this every time, the two fingers. So yeah, I mean, I think from an investor perspective, as you're thinking about how to allocate your capital, you'll hear people that are in my position say, don't invest in single family. Single family is dead. I don't think that at all. I think single family is an incredible mechanism to build wealth. I think you just have to go into with proper expectations right now. Anybody run the cash flow numbers on a single family rental lately? Yeah, they're not very good, right? It's hard to get it to pencil, but what has been great for us as a wealth building tool is not the cash flow. We've broken even. Sometimes we've lost a little bit, but the appreciation that can be generated and the equity that can be built and what you can do with that equity. And then, just selfishly to pitch, I think investing wisely with somebody that's diversified, that has experience, where you can get the cash flow, you can get the appreciation, because we've got scale and leverage and vertical integration, which private investors can benefit from. And so I would just say, be very cautious, set your expectations accordingly, know that you're not gonna cash flow like crazy in this environment. And my personal opinion is, even when there is a correction, I think the heyday of single family investing is probably behind us, because one of the things that hasn't been talked about in terms of what's driving single family pricing is, of course, supply and demand, but the institutional demand for single family. And also, I don't think this meetup would have existed 10, 15 years ago, right? There's a huge community of real estate investors and podcasts and all these things that didn't exist before, that have turned millions of people onto real estate investing that were kind of on a traditional investing path. And so the demand for investment properties at an institutional level as well as an individual level has substantially increased and is not going to go away. And so that would be my advice, is just proceed cautiously in the single family environment, get creative, and then look to who you can partner with to diversify your investments and get some scale.
Thank you. Wes?
Yeah, I agree with that. I think the demographics of investors being in this sector, the real estate sector, is, the tail's going to wag the dog, and I think that's going to continue. What I would say that we advise our owners is just a couple things. One is to stay in contact with your bankers, be in front of that relationship. If the normal duration of a commercial bank loan is 5 or 10 years, maybe locally here. But if that's coming due, you want to be in front of that. You don't want to be behind the 8 ball. And the other thing that I think that we do a really good job on, and it's just simple blocking and tackling, is like managing the expense side of the equation, and make that property, not just from an income perspective on the top line, but from an expense perspective, figure out how to really sharpen your axe, operate a property at the highest level of efficiency, and you're going to make that property more competitive to the other competitor set. If you're looking at a shopping center in East Asheville and it has operating expenses of $5 a square foot versus another shopping center not too far away, and they're at a higher per square foot operating expense, you're creating value for your owner. And that's what we really spend a lot of time doing. And we take a lot of pride in trying to figure out that equation for an owner.
Right. To your point, so when I was studying for these like investment banking and consulting things, I have these case studies. And one of them is just that, right? Profit is just a function of revenues minus costs, right? And so if your revenues are going down, you got to look to the costs, right? That's the only way to control it. So
sage advice there.
Well, to make sure we leave audience time for audience questions here, so get your questions ready. This will be the last question. If we're sitting here a year from now, what are we talking about? Is it the same conversation? Do we have a more positive outlook, more negative outlook? What's the prediction? And, on top of that prediction for next year, maybe what's the biggest question that you think people are going to be trying to answer next year? And, Wes, if you want to start.
No, Andrew, you haven't.
Oh, yeah. We'll start with Andrew, and we'll go to your left. So we'll go Andrew, Wes, and then finish with Chris.
No pressure.
I don't know. Yeah, I mean, the Fed signaled that rates are tapped out, that they're going to reduce rates, but and supposedly inflation has gone down, but not by a lot of the metrics that we use to gauge inflation. So goods and services have stayed high, housing has stayed high, and so I think I guess my concern is as rates tick back down, then you'll see another rush into real estate acquisition on the single family side. And prices will continue to go up. So I'm not super optimistic. I'm sorry about that. I wish I was more so on the commercial side. What I see over and over again is likely what you're going to see is regional and asset specific recessions or corrections. Specifically, my focus being multifamily and residential. What I know is that there's a real flight from office and some retail, some hospitality into industrial, into multifamily, and just kind of being in the world that I'm in, talking to the people that I talk to. There's more. I think what makes this next cycle different than the last cycle is there's a lot of dry powder out there. So there's on a high net worth side, on a institutional side, on kind of the in between side, there's hundreds of billions of dollars out there waiting for pricing to get a little bit more attractive. And so it's not as if, again, my opinion, I don't know the future, but it's not as if there's going to be this huge foreclosure wave or this huge buying opportunity where cap rates are going to expand up to 7 or 8 basis points and we're all going to get killer deals. And I could be totally wrong. I hope that I am. I'd be the first one in there, buying and competing for deals with the rest of y'all. But I think there's just some distinctions in this cycle, which soft landing from a individual perspective, probably not. But in terms of blood in the streets for at least my particular category, my particular asset class, I don't see it.
Thanks, Andrew. Wes?
Yeah, I would say on a micro level, I'm very bullish on Asheville still. Okay, I'm bullish on North Carolina as a state. I think it's driven by in-migration of people leaving New York and California and halfbacks coming from Florida. And I think that is a tremendously strong demographic that's going to continue to drive the economy here. Let's see. I had a couple other points that I wanted to make. So I'm bullish there, but what I would say is on a macro level, on a national level, I think that we're going to see basically sideways action between now and the election. Okay. I don't think that there's going to be, I think that the current administration is going to make sure that to the extent that there's not a black swan event in a geopolitical sense, is going to make sure that the domestic economy is just painted like a Rembrandt on the wall. Okay. It's not a political commentary. It's just the facts that, I think that the Fed has pulled off a soft landing. I think the Fed is often wrong and late and early. The one thing I'll say about this is, like, economists are not very smart, and we all have opinions, but like, if they were so good, then they would tell us what tomorrow's stock market was going to do, but they can't, and none of us can. So the last thing I would say is that, like, your best advice is your own advice. That's what I would say.
Awesome. Thanks, Wes. Chris?
It's hard to follow that up, but I typically agree. I'm bullish as well on Asheville and North Carolina. I think people are going to continue to move here for a number of reasons. Quality of life is one of them. Price and cost of living here relative to other places is still attractive for some of the demographic in this country. So I'm bullish on that. One of the things that, and kind of the golden handcuff question that came up, I do think that because of the pandemic and cheap money to stimulate the economy, there's going to be a lot of housing inventory that's going to continue to be locked up in 2.9 and 3.1% mortgages. It's going to take a lot for those individuals to put those properties on the market and create inventory. So there's kind of the saying, if you want a new house, you may have to build it. And national home builders like Ryan Homes and D.R. Horton, those stocks are doing very well because of that. So I think things are going to continue to go well for our community. In terms of the social issues that Wes discussed earlier, I don't know if those are going to get better. Those are really complicated, and a lot of them ultimately lead back to affordable housing, which I think in our community is among the most difficult to tackle. It plays into our homelessness problem and a lot of other things. But from a stuffy banker perspective, I do think that things are going to get better as interest rates go down, and some analysts are saying that they may go down as much as 135 basis points next year, with further decreases in 2025. It's going to stimulate activity. Things are going to start happening again. But going back to 2.9% mortgages, I just don't know if or when ever again we may see that. It was a crazy time, and the thing that I just find interesting about all of this is the ongoing effect that the pandemic has had on our lives. Inflation leads back to it. The shortage of vehicles leads back to it. A lot of what we're experiencing now leads back to the pandemic. The increase in our community and folks experiencing homelessness leads back to the pandemic to a degree. So it's just a fascinating time. I think we'll all look back on this, not unlike how our grandparents or great grandparents looked back on the Great Depression. It's really just been unprecedented, and it's morbidly fascinating. So
very comforting, Chris. Thank you.
Yeah.
Great Depression.
Yeah. Awesome. Well, I know I'm personally always humbled and extremely grateful that our speakers are always just so candid. And so, for one, I want to just protect these gentlemen, and these are their opinions. They're not speaking on behalf of their institutions. And second, I want to thank them for these bold and honest predictions and opinions, honestly. So if we could please get a round of applause for our speakers. So we're sticklers of getting you guys out of here on time. So we have 7 minutes for questions, but if we're feeling the vibe, we'll go a little earlier. So
make them concise, questions and answers, please.
Yeah. So we're going to repeat them because we're recording this. So no matter how loud you are, we're still going to repeat it. Don't be offended. Who wants to go first? Because Rodrigo has his own question if someone else doesn't want to. Going once. Going twice. Scott.
So, at what point in time did the bump in the road become the new road in your mind? Was it a month ago, 3 months ago, yesterday?
I would say that's a difficult question to ask. Sometimes I tell myself every day is the worst day of my life, but I thought I was
in the Great Depression.
In my world, it's one thing to look at it on an Excel spreadsheet and say this company had margin compression, they're not doing very well. But when you have lunch or dinner with these people and they talk about, hey, we're having to try to figure out a way to help my daughter find childcare, or I've had to make alternate plans for retirement. I'm going to have to work another 10 years. And you're looking at them and they're already 65. So I think for me, it's connecting what I see on paper, which is the sucky part of my job, to real people and hear their stories. That reminds me that what we've been experiencing since 2020 is in fact real, and it's not over to a degree. In my world, we tend to think of things in calendar years or fiscal years, and it's easy to say, well, the pandemic was in 2020 and it ended on December 31st. But we're still feeling the ripple effects of it every day.
Wes or Andrew, do you guys want to add anything to that? Or
I mean, for me, I mean, like, I think I've personally, I've always been an agent for change. Like, to me, change creates opportunity. Adversity creates opportunity. In my previous life, I was a commodity futures trader, one of those guys that stands in the trading pit wearing a colorful jacket, yelling and screaming and waving their arms that you've seen on TV. I did that for 10 years. And what I learned in that process, while that business is totally over based on technology, what I learned in that process was that, like, you had to be adaptable to the changing environment of the marketplace. And I had to change my mind like that. I mean, like that, not once a day, but 20 times a day. And so that's in my maturity of my almost 55 years, I've learned, and I've shared this with some family members, that, like, while I didn't think I was gaining a lot of skill doing that business, I did learn how to be adaptable to market changes. And so for me, I kind of welcome it and I'm good with it, but I understand that change is not always easy.
Andrew?
Yeah, I think it was probably twofold for me. I think when COVID hit, I thought, here they come, here come the deals. And then when the Fed raised interest rates at unprecedented levels, I thought, here they come. And so it's been I would say a progressive revelation for me, or acceptance that there's just some fundamentally different factors at play in this market cycle.
All right, thank you. All right, anybody else have another question? No questions.
All right, Rodrigo, what's your question? It was a good one.
So, although this is very different, obviously, than 2008 for a variety of reasons, it's just, maybe it's a two-part question. Is there anything, as you guys are looking, in your own organizations, as far as what to do next, that you're looking back that far to just try to, as they say, like, history doesn't repeat itself, but it rhymes, to see where the rhymes are? Or are there any trends that you're paying attention to that you think are going to be really important to keep an eye on? Obviously, there are some big companies that came out of the last 2008, and there's some big changes to the way we live life from that. And so wondering if you're seeing any of that, or kind of what's your thought process around either one of those things?
I mean, I guess would kind of piggyback off of what Wes said. I think that, I talked about how we're positioned, just getting more conservative and looking more towards the lending and the development side. But I think also there's going to be more room for creativity and entrepreneurial thought. And real estate investing has been kind of boring traditionally. It's like buy a house and rent it out. And I think that it's going to become more of a team sport where people collaboratively get together and figure out ways to build wealth with their different skill sets and backgrounds. I think you're just going to see, this co-living thing, I think, is really interesting. I think that's going to become a necessity for a lot of people. So I think there's opportunity there. I think you're just going to see a lot more creativity and entrepreneurial thought applied to real estate investing going forward. And then obviously leveraging technology and AI and all that jazz. And I feel old just saying that, but those are my 2 cents.
Cool. Wes?
Yeah, I was gonna say AI. I mean, it's become so ubiquitous and somewhat cliche, but what I see in the property management realm for how AI can sort of change our business, I'm pretty excited about. I mean, I got 60 properties to manage and have to come up with 60 budgets every year, and if I can plug that into some sort of artificial intelligence that is reliable and it's going to save a huge amount of time. So property technologies is very interesting to me. I would say, going back to your question about, looking at a structure, a mortgage that's 40 years or 50 years or 100 years. I mean, one thing I can tell you from my previous life on Wall Street was Wall Street needs to create products to trade. So you're going to see those things happen. I promise you. In the 80s and 70s and 50s, it was the stock market. Then stock market said, hey, we have this idea about what are options on stocks. And all of a sudden we started trading options on stocks. So whatever your opinion is about Bitcoin, whether it makes any sense or not, I'm not here to tell you that. I can just tell you it's going to be a product that people are going to want to trade in, and Wall Street is not ignoring it. And so these things this is where my mindset goes. And, I just share that with the group.
Awesome. Thank you. Chris, do you have anything?
Yeah, I would just say that unfortunately, I think we're going to continue to see downturns and periods of expansion, which is a component of the economic cycle, right? So you're going to have periods of deregulation followed by challenging circumstances for Americans and folks in the global economy. And then it'll be followed by a correction, which may be regulation buckling down. I mean, a great example of it is in 2006, 2007, you could walk into a bank, and if you had a 800 credit score, you could borrow $500,000 without proving your income. And people said, that'll never happen again. We're not going to make that mistake. Well, you can get no ratio loans right now. You can do debt service coverage loans that aren't based on personal income and really digging into someone's the propensity to pay the loan back. So I think history is circular much more than it is linear. We'll in all likelihood 10 or 11 or 12 years from now we'll be facing another challenge and making promises to one another how we won't get into this situation again.
All right, awesome.
I just hope we're better prepared for it.
Yeah, thank
Perhaps.
you, Chris. Somebody has a quick question. We'll sneak it in. If not, we'll get you out. Okay. Now there's questions.
There
Come
we
on,
go.
guys.
There we go.
All right, so we have 2 questions. If you both promise to make them 15-second questions, we'll try to make it happen. Caleb, go first. So question is, Wes, what's the price point that you consider workforce housing? Wes does commercial
I'm not an
management.
expert on
yeah.
workforce housing, so I'm gonna
Dr. Davis.
defer to Andrew.
Yeah.
Yeah, so for us, it's that very simple formula is just whatever the median household income is in an area, that we're going to ensure that the rent in one of our communities does not exceed 30% of that. And so to give you a number, an average number, the average rent in one of our communities is $1,200.
$1,200, sorry, as a rental price or okay, got it. All right, and Spencer, question. So I think the question is, what has to happen in the economy for the money on the sidelines to jump back in? Does anybody have a take?
I mean, typically the answer would be capitulation of some sort, but I'm not sure we're going to see that. All right. I mean, that's where the opportunity lies. I think we're going to see that's why I said we're going to see some sideways sort of action between now and the election. And then I think you're not going to be able to hide the real facts of what's happening in the economy. And that's where the opportunities are going to lie. So I would just say keep your powder dry. And I think that's what we're seeing probably in the marketplace right now, especially on the banking side, I got to speculate, is that, people are just waiting. They're just waiting. And that's not a bad thing. It's okay.
Do you guys want to add anything to that or?
Yeah, I would just say, I mean, at some point, asset pricing becomes attractive, right? So office in New York is not attractive right now. At some point, it does become attractive. At some point, it becomes feasible to buy that property at a great basis and convert it to apartments. And so I think there will be a point in different asset classes where it becomes very attractive, and especially the institutional dry powder. They don't have the same targets as your individual investor. They're very happy with 6, 7, 8. They're thrilled with 9% as long as it's super conservative. So they've got different. They've just got totally different metrics than your individual investor. So I think it will become attractive at some point. I'm speaking specifically from a multifamily residential perspective, and there's so much demand in that sector. I just don't see a massive correction there on a national level.
Cool. Awesome.
I would just add, I think on an individual basis, people are going to look at their worth, whether it's cash or real estate or whatever, and make individual ROI decisions. I've met with folks recently who have kind of we've done math together on an acquisition, and they're like, well, if my return on this is 6 or 7%, and I'm subject to tenant rollover risk, economic headwinds, and I can go buy treasuries and get 4.5 or 5% with zero risk, why would I do that? And my answer is, I don't know. You shouldn't. I guess I can take you off my loan pipeline. But but those conversations are the type of conversations that folks have as a family, individually, and then with the folks that they trust. And I think, I guess what I'm saying is there's probably no right answer, but it's going to take some sort of movement, some sort of opportunity, and a bit of individual math that kind of aligns with their risk profile. A lot of a huge amount of the money in this country is still controlled by baby boomers, and as they get older, their risk profile is going to change. So you're going to see them making less moves in terms of purchasing real estate and things of that nature. So could come to play.
All right, guys. So we're going to end it on that note. Thank you guys so much. Please, big round of applause for our panel tonight. So we typically meet on the first Tuesday of every month, but the first Tuesday of January is January 2nd, and nobody wants to meet on the 2nd, so we're going to meet on the second Tuesday of January, which is going to be January 9th. So we'll see you guys back here. Subscribe to our YouTube channel, please, guys. Help us out with that. Listen to the podcast. Share with your friends. We'll see you all back here in January, year in review. So we'll kind of do something similar to what we did last year. Thank you all so much for being here, and have a great night. Hey guys, Rodrigo here. Wanted to say thank you for taking the time to listen into this month's panel conversation. We hope that you join us in person at next month's meeting. You can find out more at avlmeetup.com. We primarily meet on the first Tuesday of every month, but be sure to check out our website, avlmeetup.com. You can also watch this conversation on YouTube at AVL Meetup. Also, I have a quick announcement. We started a property management company called Vesta Property Management. So if you're looking for third-party management for long-term rental, we'd love the opportunity to talk to you. Our goal at Vesta is to turn houses into homes and investments into returns. If you're looking to work with a third-party management company that will allow you to have peace of mind and experience freedom around rentals, reach out to us. We can help make that happen for you. VestaPM.com.
What's going on, everyone? Zac here to close it out before you sign off for the day. If you liked the data-driven portion of today's meetup, then I'd love to take a moment to tell you about the Ruiz Report and REMC. If you're a real estate professional, then you know that you should become the local economist of choice, but you're probably unsure of how to learn the skills required. That's where the Ruiz Report comes in. We offer customized market reports to promote your business, training videos so you'll learn how to interpret the market data, and monthly quizzes to keep you sharp. Learn more at ruizreport.com and sign up for a free account to watch all of our training videos at no cost. If you're more interested in the live data and some data and analytics dashboards, then I highly suggest you check out remc.co. REMC is the first of its kind data and analytics dashboards for the real estate industry. Now, you have to be an active participating member of the MLS in order to sign up, but it is unparalleled data on every market participant, whether that's an office, a listing, or one of the realtors. Again, you can find out more about REMC at remc.co. As always, thanks for listening, and we hope to see you at one of our next meetups. If you can't make it and you still want to be part of the movers and shakers, then sign up for a free account at avlmeetup.com and get yourself into our member directory. Thanks again. See you next month.